Every generation thinks their crisis is the last. Every boom feels permanent, until it isn't. And yet, beneath every collapse, something predictable unfolds. A quiet movement of money, a transfer of wealth from those who react to those who prepare. The story of the next great financial reset won't begin with chaos. It will begin with silence. The same eerie calm that came before every previous collapse. The numbers on the screen still look fine. The charts are still green. But the pattern, the ancient rhythm of market cycles, has already begun to turn. History whispers before it screams. And what it's whispering now sounds familiar. We've seen it in 1929, when too much confidence became the weapon that destroyed fortunes overnight. We saw it in 2008, when leverage and denial painted a golden age just before it cracked. And we may see it again as the global economy strains under invisible weight, debt, speculation, and an emotional loop that never learns. Most people think collapses are about numbers, interest rates, inflation, policies. But they aren't. They're about behavior, about financial psychology, about the way people convince themselves that this time is different. Because every economic collapse starts in the same place, the mind of the crowd. We buy because others buy. We trust because others seem to. We stop asking questions when the system rewards our obedience. And then, when the floor gives way, we look for someone to blame. But history never blames anyone. It just repeats. The wealth transfer that follows each crash isn't random. It's designed by the very structure of human behavior. Our fear, our greed, our inability to sit still when uncertainty grows. Those who understand the psychology of investing know this pattern intimately. The unprepared lose what they borrowed. The patient gain what they waited for. So when you hear the word reset, remember, it's not just a policy term or a headline. It's a signal that the pendulum of behavioral finance is about to swing again. And in that swing, millions will move from security to scarcity, while a small, calm few will watch the same data differently. This video is not about predicting the next market crash. It's about recognizing the script that always plays before one. Because whether it's 1929, 2008, or 2026, the ending has never changed, only the actors have. So the question is not if there will be another collapse, it's who will understand it before it happens. Stay with me, because once you see the pattern, you can't unsee it. And once you understand how every market collapse transfers wealth, predictably, you'll never look at optimism the same way again. History doesn't just repeat, it rhymes in interest rates and emotions. Every financial empire from Rome to Wall Street has followed the same rhythm of rise, excess, and correction. What changes are the symbols: gold coins, tulips, tech stocks, crypto. But the money patterns stay the same. Let's go back to 1929, the Jazz Age, a decade of unshakable optimism. Everyone believed they had found a new era of endless growth. Ordinary people bought stocks on margin, borrowing money to chase the illusion of effortless wealth. Newspapers glorified the market as a path to freedom. And then, in a single autumn week, the illusion dissolved. The crash didn't just erase fortunes, it rearranged them. Those who held cash, patience, or simply doubt became the quiet inheritors of wealth. This wasn't a coincidence. It was the predictable wealth transfer that happens whenever a society forgets that growth has limits. After the 1929 collapse came policy, reform, and an entire generation shaped by scarcity. Yet just a few decades later, the pendulum swung back. The U.S. detached from gold. The dollar was no longer tied to anything physical, just trust. That trust became the new currency. And when faith replaces discipline, cycles shorten. Then came the 1980s, the era of credit. Buy now, pay later became not just a slogan, but a worldview. The markets rose again, this time faster, louder, more leveraged. But behind the music, the same financial history unfolded. Easy credit breeds fragility. Fragility breeds panic. Panic breeds transfer. 2008 was supposed to be the crash that changed everything. Instead, it revealed how little we had learned. Housing prices, derivatives, complex products designed to mask risk, all built on the same psychological foundation as 1929, belief that prices can only go up. When the illusion broke, wealth didn't disappear, it moved, from homeowners to banks, from small investors to institutional buyers, from those who reacted to those who waited. The wealth transfer was again invisible in real time, but crystal clear in hindsight. It followed the same script: overconfidence, leverage, denial, collapse, consolidation. And if we zoom further back, even ancient economies followed this rhythm. In Rome, inflation and debt crises hollowed the middle class. Land concentrated in the hands of the patient few. In 17th century Holland, tulip bulbs became status symbols until the moment they became worthless. Every economic collapse across history has rewarded emotional discipline and punished crowd emotion. That is the cruel symmetry of financial psychology. It doesn't evolve. We keep inventing smarter tools, but not smarter behavior. The same cycle plays out in every generation because the system feeds on belief, and belief has no memory. So when people today say, "This time is different," remember, that phrase has appeared in every financial obituary ever written. The details of technology and policy may change, but the emotional infrastructure of market cycles does not. Panic still begins in the same place. Too much confidence. Collapse still ends in the same place. Too few prepared. The great irony is that in every wealth transfer, money flows toward those who least crave excitement. While others chase signals and headlines, they wait for gravity to do its quiet work, and history rewards them. Not because they predicted the crash, but because they respected the pattern. So why does this keep happening? Why does every era, no matter how advanced, recreate the same collapse in a new disguise? Because it isn't primarily an economic problem, it's a human one. Markets are mirrors. They reflect our collective psychology with mathematical precision. When optimism expands faster than productivity, when belief grows faster than value, the reflection distorts, and the distortion becomes policy, culture, and eventually, crisis. At the core of every financial system lies a tension: the need for stability and the desire for growth. Stability feels safe, but it slows returns. Growth feels rewarding, but it demands risk. So we invent tools, derivatives, credit, AI-driven investing, crypto assets, to stretch that tension without snapping it. But these tools don't remove risk. They relocate it. The system behaves like a spring. The more we compress uncertainty, the stronger the recoil when it breaks. This is the anatomy of a market cycle. Not a random accident, but a psychological mechanism expressed in economic form. In the early stage of expansion, optimism is rational. The world feels orderly. Productivity and prices rise together. Confidence builds. Then, slowly, the story changes. Investors stop measuring risk. They measure confidence itself. Narratives replace numbers. The investor mindset shifts from cautious accumulation to emotional participation. In this middle phase, speculation becomes identity. Owning the right stock or asset becomes proof of belonging. Analysts echo each other. Media amplifies belief. Governments, dependent on growth, reinforce it. The loop is complete. Belief sustains price. Price sustains belief. Then comes the inflection. A tremor in confidence. A headline, a missed forecast, a small liquidity freeze. The market doesn't crash, it flinches. But in that flinch lies the truth. The whole structure is a behavioral ecosystem built on synchronized emotion. Panic spreads faster than logic because it requires less energy. One person sells for a reason. 10 sell from observation. 1 million sell from fear. Behavioral finance calls this herding, a deeply wired survival instinct misapplied to numbers. When the feedback loop reverses, leverage magnifies the descent. Governments intervene. Central banks inject liquidity. Confidence temporarily returns. But the pattern remains. Each bailout teaches participants that risk will be absorbed, so they take even more next time. That's how systemic fragility compounds. It's not just greed, it's learned behavior. The system teaches investors to expect rescue, and investors teach the system to expect obedience. And somewhere between stimulus and speculation, the real economy, wages, production, value, gets replaced by sentiment. By the time the economic collapse becomes visible, the transfer has already occurred. Those who exited quietly during euphoria are liquid. Those who stayed for one more high are trapped. This is why every wealth transfer is predictable in structure, if not in timing. It's driven by asymmetry of knowledge, emotion, and patience. Most people react when it's too late because their time horizon is emotional, not financial. They measure comfort, not probability. The calm investor doesn't know the future. They just understand the mechanism. They know that markets reward preparation over prediction. They know that the crowd's pain is the price of their patience. They know that in every cycle, survival is the real alpha. If you trace any investing behavior to its root, you'll find emotion disguised as logic. The rational investor is often rationalizing. The contrarian is often just late. And the long-term thinker is often long only because they haven't noticed the tide turning. Understanding this mechanism doesn't make you immune, but it makes you aware. And awareness in a system built on reaction is a form of quiet resistance. Because the next collapse, whether in 2026 or beyond, won't come from new math. It will come from the same neural circuits that have been firing since Mesopotamia traded grain for silver. Fear, greed, denial, repetition. The systemic mechanism of collapse is simply human nature, leveraged to infinity. Look around you. The pattern is still here. Only the symbols have changed. Today's markets move not by human hands, but by algorithms trained on human impulses. Artificial intelligence reads emotions faster than the people who feel them. It trades fear and greed in milliseconds, scaling psychology into code. Yet the outcome is the same: confidence, leverage, denial, collapse. This is not 1929 or 2008. It's quieter, more digital. But the global economy hums with the same nervous rhythm. Debt has reached record levels, not just in households or nations, but in belief. People borrow against future optimism. Corporations borrow against projected growth. Governments borrow against time itself. And somewhere in the background, the market starts pricing the impossible. Eternal expansion without consequence. We tell ourselves it's sustainable because technology makes everything faster, cleaner, smarter. But no code can rewrite human emotion. The AI-driven investing behavior we celebrate today is still built on data that mirrors our own irrational past. It learns from us. And when we panic, it will too. Faster, sharper, deeper. Analysts quietly mention 2026 as a potential turning point. The market crash 2026 theory spreads through headlines and think pieces. Some laugh at it, others prepare. Both are reacting to the same invisible pressure, the tightening of the debt spiral. In a sense, we're already in a slow-motion economic reset. We just don't feel it yet. The indicators still glow green. The stock indexes still rise. But beneath that glow, liquidity is thinning. Money is moving, quietly, as it always does before the curtain falls. Retail investors celebrate every bounce as proof of recovery. Institutional ones treat it as opportunity, one more chance to unload risk. It's not manipulation, it's choreography. The system transfers fragility from those who understand it least to those who can carry it longest. And if history is a mirror, the reflection is clear. We are living through the late stage of another cycle. The numbers are bigger, the screens brighter, but the psychology unchanged. You can see the tension everywhere. In luxury real estate bought with borrowed optimism, in speculative bubbles that rise faster than they can be justified, in the silence that follows every policy announcement meant to restore confidence. Confidence isn't restored, it's manufactured. The faith holding the global economy together today is algorithmic faith, lines of code simulating belief. And when that faith wavers, the cascade will not be a panic of traders shouting across floors. It will be screens going dark, liquidity drying in seconds, trust evaporating at the speed of light. But collapse doesn't mean destruction. It means reallocation. Every reset is a reordering of ownership, the same wealth transfer written in new code. The question isn't whether the next downturn will happen, it's who will recognize the rhythm before it does. Because the market cycles we face now are no longer measured in years. They remeasured in reactions per second. The 21st century has turned behavioral economics into behavioral automation, and the paradox of progress is this. The smarter the system becomes, the more ancient its mistakes appear. So, as we move closer to the next great reset, the calmest mind will once again be the richest. Not in speculation, but in understanding. Not in noise, but in silence. Because in this new era of high-speed fear, those who pause will see what others can't. That the algorithm isn't replacing us, it's revealing us. If markets are mirrors, then crashes are moments of truth. They strip away the stories, the metrics, the justifications, leaving only the human mind, facing its own reflection. At the core of every financial psychology study lies one uncomfortable reality. People don't invest in assets, they invest in feelings, security, status, control, hope. These emotions masquerade as strategy, but they drive the very volatility investors claim to fear. When prices rise, the crowd calls it proof. When they fall, the crowd calls it manipulation. But what they're really seeing is themselves, amplified through billions of transactions. The most successful investors across history weren't necessarily smarter, they were quieter. They practiced what could be called quiet investing, the ability to remain still while everyone else moves. They understood that the greatest returns don't come from predicting change, but from enduring it. The wealth mindset that survives collapse isn't built on optimism. It's built on neutrality. To watch a falling market without panic requires emotional liquidity, the ability to stay detached even when the world screams urgency. Most people think intelligence protects them from mistakes. But in behavioral finance, intelligence often reinforces bias. Smart people don't stop being emotional, they just rationalize faster. That's why during every economic collapse, education alone isn't protection. Awareness is. Awareness that your brain craves certainty more than truth. That the dopamine rush of gain feels safer than the discipline of patience. That selling too late feels heroic, until it isn't. Fear and greed are not opposites. They're the same signal in different phases of the cycle. Greed says, buy before it's too late. Fear says, sell before it's too late. Both are emotional predictions of regret. In 1929, 2008, and in every crash between, the same mental loop played out. Denial, hope, panic, blame. It is not just markets that collapse. It is identities built around the illusion of control. But here's the paradox. Awareness of the pattern is what ends its power. The moment you recognize your own participation in the crowd, you step outside it. You stop chasing reassurance and start observing reality. The investor mindset that endures is minimalist. It treats money as a language, one that rewards silence, patience, and preparation. To that mindset, volatility is not an enemy but a teacher. Each collapse becomes a rehearsal for resilience. In this light, wealth transfer is not just financial. It's psychological. During collapses, emotional wealth transfers from the reactive to the reflective. from those who panic for comfort to those who sit with discomfort. True wealth, then, is not possession but perception. And the ultimate investment is not in markets. It is in the discipline to see clearly when clarity vanishes. That's why the most powerful strategy in any cycle isn't to outguess the system, but to outweight it, quietly, patiently, without drama. Because the markets don't reward excitement, they monetize it. They convert emotion into liquidity. And every panic is just the sound of that conversion happening in real time. The prepared investor, the one grounded in financial psychology, doesn't chase certainty. They build systems that work even when they're uncertain. They understand that in every reset, the opportunity isn't in prediction, it's in perception. Markets change because people don't, but people can change once they see why markets do. So where does this leave us? Not in fear, but in focus. Every economic reset is a mirror held up to human nature, revealing, once again, what we choose to ignore when times feel good. The markets don't collapse to punish us. They reset to remind us that behind every chart, every policy, every algorithm, there is a human heartbeat. Impatient, hopeful, fragile. If you step back far enough, you can see the symmetry, the rise, the euphoria, the denial, the reckoning, and finally, the silence. That silence is not destruction. It's recalibration. It's the system taking a breath, and during that breath, the transfer happens, not just of money, but of meaning. From those who saw the market as a game, to those who saw it as a teacher. From those who chased trends, to those who studied behavior. From those who wanted to be rich, to those who wanted to be ready. This is the essence of wealth transfer. Preparation disguised as luck. If history has taught us anything, it's that cycles don't break. They evolve. Every collapse builds the blueprint for the next expansion. Every panic becomes the seed of the next recovery, but only for those who stayed calm enough to learn while others fled. That calm is not apathy. It's awareness. Awareness that the global economy doesn't need your fear to function. It needs your participation. But participation without awareness is just noise. And noise is what the system feeds on. So if you've ever wondered why the same people seem to rise from every crash stronger, the answer isn't insider information. It's insight. They understand that uncertainty is permanent and fear is optional. They don't waste energy predicting market cycles. They build principles that outlast them. They treat financial storms like seasons, inevitable, temporary, rhythmic. The next market collapse, whether in 2026 or 2036, will not announce itself. It will arrive disguised as normalcy, with optimism at full volume and doubt at zero. And when it does, the world will divide again, between those who react and those who reflect. If you're listening to this, the goal is to escape the cycle. It is to see it clearly enough to step outside its panic, to observe what others dramatize, to understand that the real investment is in awareness itself. Because preparation is not building bunkers or hoarding assets. It's building emotional clarity, the ability to respond with discipline when others respond with noise. So, as this cycle turns, as headlines swing between hope and despair, remember, every generation thinks their crisis is the last. But the pattern endures, waiting for those calm enough to learn from it. The next wealth transfer will happen in silence, in the pause between denial and realization. And those who are ready will not just survive it, they'll understand it. Because understanding the psychology of collapse isn't fear, it's preparation.